Yesterday afternoon, the United States Mint quietly erased the Buy Now button from its website. Not out of stock, not coming soon, vanished. One moment you could buy a Silver Eagle, the next, the option was gone. This morning, the official narrative is calling it a temporary technical suspension, a responsible pause amid market volatility. They want you to believe this is just prudent risk management. They are lying to you. For 12 years, I've tracked the physical inventory that's supposed to back the paper price. This isn't a technical glitch, it's a distress signal. The U.S. Mint didn't stop selling silver because the price is too high. They stopped selling because they can no longer get it. This is the first domino. And if you think this is just an American problem, you haven't seen the delivery reports coming out of London. This isn't just a headline for Wall Street traders. This is a direct threat to the dollars in your bank account, to the value of your retirement fund, to your family's financial future. The number you see on the screen, that $90 spot price, is quickly becoming a fantasy. Right now, the real in-your-hand price for physical silver is soaring past $135 an ounce. That's a 50% gap between the official price and reality. Think about that. For every 2 ounces of silver your money is supposed to be worth, you can only actually buy one. This isn't a premium. This is a wealth seizure happening in plain sight. Your ability to convert paper promises into a real, tangible asset is evaporating. The U.S. Mint just turned off the spigot. Private dealers are being picked clean. This isn't a temporary glitch. It's a structural failure. The system that is supposed to guarantee your access to real money is breaking, right now, in real time. So how did the paper price of silver become the biggest lie in modern finance? To understand how a sovereign mint runs out of metal, you have to understand the game that's been played for the last 15 years. After the 2008 crisis, the rules were simple. The price of silver wasn't set by physical supply and demand. It was set in the paper markets of New York and London by a handful of bullion banks. Think of it like this. For every 100 ounces of physical silver sitting in a registered vault, these banks could create thousands of paper contracts, futures, options, ETFs, all claiming ownership of that same silver. As long as very few people demanded actual delivery, the system worked. The paper price stayed low, and the banks collected their fees. They built a financial machine designed to contain silver, ensuring it never threatened the dominance of the dollar. But they made a fatal miscalculation. They forgot you can't build an electric vehicle with a paper promise. Starting around 2021, the world's industrial giants quietly became the largest buyers on the market. Every solar panel, every 5G tower, every microchip became a vacuum cleaner for physical silver. Last year alone, industrial demand outstripped new mine supply by over 230 million ounces. Write that down. 230 million ounces that had to come from somewhere. For years, that deficit was filled by draining existing stockpiles. But now, those stockpiles are hitting rock bottom. The industrial users are calling the banks bluff. They don't want the paper. They want the metal. And the price you see on your screen has no connection to the reality of that physical scarcity. This entire house of cards was built on a hidden mechanism, a pressure valve, designed to keep the paper fantasy from colliding with the physical world. And that valve just failed. The game was simple because the players were powerful. After 2008, central banks flooded the world with trillions in new currency. To keep that tidal wave of cash from sparking hyperinflation, they needed to control the traditional barometers of fear, gold and silver. So the bullion banks, the JP Morgans and HSBCs of the world, stepped in as the system's managers. Their tool of choice? The COMEX futures market. Here's how the machine worked. For every single ounce of real, physical silver sitting in a vault, the banks could create and sell 100, 200, sometimes even 500 paper contracts representing that ounce. Think of it as selling 500 tickets to a single seat in a theater. The scheme only works as long as everyone doesn't show up at once demanding their seat. For 15 years, it was the perfect price suppression tool. Anytime investor demand pushed silver's price up, the banks would unleash a flood of new paper contracts, overwhelming the market and crushing the price back down. They could create a limitless supply of paper to meet a very real demand for metal. This gave you the illusion of a deep, liquid market. It kept the price stable, predictable, and most importantly, low. It was a gilded cage designed to trap capital and prevent a panic. But what happens when people stop wanting the paper ticket and start demanding the actual metal? The entire system relies on a bluff. And for the last 18 months, a massive, unseen player has been quietly calling that bluff, exposing a hidden mechanism at the heart of this collapse. So how is this possible? How can the U.S. Mint run out of a metal when your screen says the price is only $90 an ounce? It's because you're being shown the wrong price. You're looking at a shadow. The real action is happening somewhere else, governed by a mechanism I call the Great Disconnect. Think of it as two separate markets for the exact same thing. First, you have the paper market. This is the futures price you see on Bloomberg, the number every financial news channel quotes. It's not a price for silver in your hand. It's the price for a promise of silver, delivered sometime in the future. For years, this paper price has been used to control the narrative, to keep a lid on things. Second, you have the physical market. This is the real world. It's the price a mint pays to acquire the massive silver discs, the planchets, before they can be stamped into coins. But they aren't anymore. Imagine you walk into a dealership to buy a new truck. The sticker price on the website is $50,000. But the lot is completely empty. The dealer just shrugs. He can't get any. Then you see a guy in the parking lot with the exact truck you want. He just bought the last one. And he'll sell it to you right now for $80,000 cash. Which one is the real price? The one on the website or the one that actually gets you the truck? That's the Great Disconnect, the U.S. Mint is trapped in the middle. They're the dealer, forced to honor a sticker price that has no connection to reality. They have to buy their silver at the parking lot price, but are expected to sell it to you at the website price. When that gap gets wide enough, the whole system shorts out. They have no choice but to pull the plug. This isn't a theory. The gap between the paper promise and the physical price is measurable. It's a number. And when you run that number, you don't just see a problem, you see a countdown clock. This isn't just a market. It's two markets, running in parallel. One is real, made of physical metal you can hold in your hand. The other is a phantom, built from paper contracts and digital promises. For years, they've been shackled together. Now we are witnessing what I call the Great Silver Uncoupling. Here's how the game has been played, step by step. First, the price you see on your screen is set on futures exchanges like the COMEX. Here, banks trade contracts for silver. They can create and sell a contract representing 100 ounces of silver without actually having 100 ounces of silver. They are, in effect, creating paper metal out of thin air. Second, for decades, these banks have used this power to manage the price. Anytime physical demand starts to push the price up, they can flood the market with billions of dollars in new paper contracts, overwhelming the real buyers and hammering the price back down. It's a powerful illusion. Third, the entire system relies on one critical assumption, that almost nobody will ever ask for the real metal. As long as traders are happy to settle their contracts for cash, the banks never have to prove they have the silver they supposedly sold. Think of it like a valet service at a sold-out stadium. They've given out 5,000 parking stubs, but they only have 50 parking spots. It works fine, as long as everyone leaves at different times. But what happens when the game ends and all 5,000 people rush the valet stand at once, demanding their car keys? That is what is happening right now. The game is over. Industrial users, sovereign mints, and individual investors are all rushing the valet stand. They don't want the paper stub anymore, they want the car. They want the physical metal. The U.S. Mint showed up to get its keys, and the valet just shrugged. The lot is empty. This isn't a guess. It's not a prediction. The evidence is right there in the exchange data, hiding in plain sight. And when you run the numbers, you see the deficit isn't just a problem, it's a mathematical black hole. The numbers don't lie. And these are the numbers the banks hoped you would never see. Right now, on the COMEX exchange, a staggering 36 million ounces of silver are standing for delivery. That's not for the whole year. That's for this month. To put that in perspective, that's more than 2 full months of output from Mexico, the largest silver producer on the planet. All of it demanded in a single 30-day window. But that's just the paper market. Here's the number that proves the physical game is over. Your screen says silver is $90 an ounce, but try to buy it, right now. Go ahead. Authorized purchasers are reporting physical premiums of 50% over that paper price, if they can even get an allocation. Do the math with me. $90 times 1.5 is $135. That isn't a premium. That's a panic price. It's the market screaming that the emperor has no clothes. This is the mathematical result of a 300 million ounce structural deficit. That's the number whispered in the industry, the one no one wants to say out loud. For every 10 ounces of silver demanded for solar panels, EVs, and investment bars this year, only about 8 ounces are being pulled from the ground. For years, they filled that gap by draining the vaults in London and New York. But now, the vaults are running on fumes. The U.S. Mint just sent up the flare. So what happens when a 300 million ounce vacuum gets turned on in a market held together by digital promises? The system doesn't just bend, it snaps. And when it does, there are only 3 ways this can play out from here. That 36 million ounce demand isn't happening in a vacuum. It's a claim check being slammed on the counter of a warehouse that is nearly empty. The official COMEX report will tell you there are 45 million ounces of registered silver in their vaults. On paper, that looks fine. A 9 million ounce cushion. But this is the lie that keeps the whole system from imploding. Registered simply means the bar is the right shape and purity. It doesn't mean the owner is willing to sell it. It's like looking at every car in a parking garage and assuming they're all for sale. They aren't. The real number? The amount traders are actually willing to part with for $90 paper dollars? Insiders I talk to say it's barely 20 million ounces. Do the math with me. Demand, 36 million. Real, available supply, 20 million. That is a 16 million ounce black hole opening up in the heart of the market this month on just one exchange. And this is where the contagion starts. Because every single entity that gets stiffed on delivery in New York, the banks, the mints, the industrial giants like Apple and Tesla, they will all pivot and make a panicked phone call to the only other vault that matters. The LBMA claims to hold 850 million ounces. A staggering number. But it's a gilded cage. Over 700 million of those ounces are legally owned by ETFs, held as sovereign reserves, or allocated to private clients. That silver is not for sale. It cannot be touched. It's like looking at a bank's vault but forgetting that the money inside belongs to its depositors. The real floating supply for the entire planet is less than 150 million ounces. And a 16 million ounce deficit from New York is about to become a vacuum cleaner aimed right at it. The system is no longer just broken. It's running on fumes. The engine is seizing in real time. So what happens when the paper promises are finally called and the vaults are proven empty? There are only a few possible roads from here, and you need to understand every single one of them. So what happens now? When the gears of this machine finally grind to a halt, what does the world look like? As I see it, 2 primary paths are emerging from the chaos, and you need to understand both. Let's call the first one the controlled demolition. This is the scenario the central banks are desperately trying to engineer. They find the metal. They raid a private vault in Zurich. They twist the arm of a major industrial ETF, and they satisfy just enough of that 36 million ounce delivery demand to calm the markets. The U.S. Mint might come back online in a week, but with strict 1 coin per household rationing. The paper price gets hammered back under $90 as they flood the market with a fresh wave of shorts. The system bends, but it doesn't break. The financial media will call it a successful stress test. Let's put the probability of this at 60%. It's the path of least resistance. But then there is the second path, the force majeure. This is what happens if the metal simply isn't there. One major bullion bank fails to deliver. It's a quiet default at first, settled in cash. Then another. Then panic. COMEX is forced to halt trading. The price on your screen freezes at $90.38, but it's an artifact. A museum piece. The real price is discovered in frantic phone calls between dealers, and it starts with a 2. $200? $250? The LBMA in London follows suit within 48 hours. This isn't a squeeze. It's a reset. The probability? I'd put it at a terrifying 40%, and it's climbing with every truck that leaves the COMEX empty. Of course the skeptics will roll their eyes. They'll tell you we've seen this movie before, that the banks always find the metal, that they can print paper contracts forever to crush any rally. And in the past, they've had a point. But this time, they are ignoring the one player in this game who just changed all the rules. The first path is what the insiders are hoping for. I call it the controlled demolition. In this scenario, they don't try to fix the system. They break it on their own terms. The COMEX and the LBMA declare a temporary force majeure, suspending all physical delivery. They try to settle every contract in cash, forcing you to accept rapidly devaluing dollars instead of the metal you were promised. To create confusion, they might even slam the paper price back down to $80, maybe even $70, to shake out the weak hands. But in the real world, the price of a 1-ounce coin you can actually hold could leap to $150, then $200 overnight. The gap between their price and the real price becomes a chasm. Then there is scenario B, the great unplugging. This is what happens when control is lost. The default isn't managed. It's a catastrophic failure. One major bank fails to deliver, and the chain reaction is immediate. Confidence in the entire paper market evaporates in a single trading session. The price doesn't just re-rate, it breaks entirely. Price discovery moves from the futures exchanges in New York and London to the physical dealers on the street. What's the price then? $200 an ounce? $500? What is the price of something real when the fiction is finally exposed? I'd put the probability of the controlled demolition at 70%, but that leaves a terrifying 30% chance of a complete, uncontrolled reset. Of course, the skeptics will tell you this is just fear-mongering. They'll say it's a temporary supply chain issue, that the banks can print infinite paper contracts to contain any rally. They believe the system is simply too big to fail, but they are ignoring the one fatal flaw in their logic, the one player who just changed all the rules. Now I know what the critics are saying. And frankly, the mainstream headlines are designed to make you agree with them. They're calling this a temporary technical suspension, a precautionary pause due to market volatility. They want you to believe this is just a boring, bureaucratic hiccup, that the U.S. Mint is simply being responsible, tapping the brakes because the price moved a little too fast. And on the surface, it sounds plausible. But it completely falls apart the second you look at the data. Let's rewind to the last major silver run in early 2021. The price rocketed up nearly 20% in just a few days. Did the Mint erase the buy button from existence? No. They limited orders. They announced shipping delays. They managed the surge. They never, ever shut the entire operation down. So what makes this time different is because this isn't about the price on your screen. It's about the metal in the vault. Here is the number that exposes the official story as a lie. While the Mint cites volatility around a $90 paper price, my sources inside the wholesale market confirm premiums for 1,000-ounce bars have gone parabolic. We're talking a 40% premium over spot. 40%. That's just to get the raw industrial metal before it's ever stamped into a coin. The U.S. Mint didn't stop selling because the price is too high. They stopped because they physically cannot source silver anywhere near the price they're supposed to. The machine is broken. This is where the official narrative crumbles, and you have to decide what you believe. The sanitized press release or the hard numbers from the physical market. For me, that choice was made a long time ago, and it's reflected in every single dollar I've put to work. But the smartest objection isn't that this is temporary. It's that this is a simple logistics problem. The argument goes like this. Sure, COMEX is tight, but there are hundreds of millions of ounces sitting in London vaults and backing ETFs like the iShares Silver Trust. There's no real shortage, just a delay in moving metal from warehouse A to warehouse B. On the surface, it sounds reasonable. It sounds professional, and it's dangerously wrong. Let's look at the facts. If this were just a logistics issue, those giant stockpiles would be the ultimate backstop. But they're not acting like a backstop. They're acting like a leaking dam. The iShares Silver Trust, SLV, is supposed to be a vault. Instead, it's become a drive-through for institutions desperate for physical metal. Over the last year, we've watched a staggering 53 million ounces get pulled from its vaults. That's not metal being rerouted. That's a direct raid on the reserves. And London? The story gets even worse. The London Bullion Market Association, the heart of the global silver trade, has seen its inventories plummet to near-record lows. This isn't just 1 month of bad data. It's a relentless trend. The very vaults the critics point to as the solution are actually flashing the biggest warning sign of all. The so-called silver mountains are turning into molehills. This isn't a shell game where metal is moving from one pocket to another. This is a global vacuum cleaner, and it's sucking the physical inventory out of the entire system. The paper promises are finally being called in. And seeing these numbers, watching the emergency reserves get drained in real time, has forced me to change how I approach my own security. So the question I keep getting is, what am I doing with my own money? I'm not sitting on my hands. Yesterday morning, after I confirmed the Mint's suspension, I increased my personal allocation to physical silver. I moved it from 10% of my net worth up to 15%. For me, this isn't a speculative gamble on the price going up. It's a calculated exit from the paper phantom market. It's an insurance policy against the very system failure we are now watching unfold, minute by minute. Now let me be crystal clear. This is simply a transparent look at my personal strategy for protecting my own family's wealth. You must do your own exhaustive research and make decisions based on your own risk tolerance. My trigger for a much larger, more aggressive position is simple. I'm watching the London Bullion Market Association, the LBMA. The moment they announce any kind of delivery halt or suspension, even a temporary one, that's the final signal. That is the point of no return for the paper pricing scheme. Because what's coming isn't a gentle, orderly repricing. This isn't a stock climbing a chart. Think of it like a coiled spring, compressed for 15 years by trillions in paper contracts, the U.S. Mint just snapped one of the clamps holding it down. And when the last one breaks, we're not going to see a rally. We are going to witness a launch. This is the moment the paper market dies. The U.S. Mint didn't just run out of silver. It ran out of time. The decades-long game of suppressing physical reality with digital promises has finally hit a wall of empty vaults. This isn't a temporary suspension. It's a distress flare, a final warning that the system you trust is buckling under the weight of its own lies. The price on your screen is a phantom. The real price is being set by a desperate global scramble for physical metal. This contagion is moving faster than the news cycle. London is next. When the LBMA admits it can't deliver, the final anchor will be cut. I'm tracking the vault data as it breaks. Subscribe and turn on notifications. You need this intel before it's too late. In the end, they can control the headlines, but they can't print metal.